you, ma'am.
Yeah. Ma'am, am I audible?
Yes, you're audible. Yes, ma'am.
Welcome to the second day workshop of UGC NET JRF, Conquering UGC NET JRF. Today, we have the speaker, Mohammed Nawaz, who is working as a faculty of post-graduation in Department of Post-Graduation, R.B.A.N.M'S College, Bangalore. He is a MA graduate from Bangalore University and has qualified UGC NET and KSET. His area of specialization is accounting and area of teaching is taxation and finance. He has experience of teaching both the postgraduate and the undergraduate students of MCOM, BCom, MBA, finance, and BCom and BBA students. Sir has visited various colleges in and out of Bangalore as a resource person in the area of accounting, taxation, and finance. Sir has presented research papers in national and in international seminars and conferences and has many publications in reputed journals. Sir's main aim is to establish himself as a recognized faculty in the field of commerce and management by upgrading qualifications, knowledge and skills, and work for the betterment of student community, both in academics and overall development. I welcome you very heartily for the second day program, sir. Over to you, Dr. Mohammed Nawaz.
Well, at the outset, I would like to thank Jain College management, principal, IQSC team, research cell, faculty, and student coordinator who took up the initiative and responsibility of organizing this much needed workshop and training session on how to prepare for NET. I hope all the participants who have joined us today are very much safe during this COVID-19 pandemic, and I hope that we will overcome this global challenge and we will be back to normal at the earliest. The title of this workshop is very much inspiring indeed. It says Conquering NET and SET and JRF. SET is a state eligibility test which a state university conducts once in a year, and NET is a national eligibility test for assistant professor across India, which National Testing Agency conducts twice in a year. In the past, CBSE used to conduct this NET examination on behalf of UGC, but from December 2018, National Testing Agency has taken up the charge of conducting this NET examination. From that time, NTA took over the charge. It has brought some changes in the syllabus. In the past, you don't used to find auditing questions in the paper, but now you need to expect the auditing questions in the paper. In the past, you don't used to find business law questions in the paper, but now you need to expect business law questions in the question paper as well. And apart from the syllabus, it has brought some changes in the question paper pattern as well. In the past, you used to have the questions in sequence. You used to have the questions in a bundle of a subject. In the sense, 5 questions used to be from accounting, 5 questions used to be from taxation, 5 questions used to be from marketing, 5 questions used to be from HRM. But now, from the time NTA took over the charge of conducting the examination, you cannot predict which question number will be from which subject. And apart from that, in the past, you don't used to have the comprehensive passage questions in the eligibility test. But again, now you need to expect a question in the form of the comprehensive passage. And in this session, I was asked to speak about an important area of our commerce and management stream and an important segment of your NET and KSET syllabus, that is income tax. Before I could start speaking about the income tax, I want all of you to understand the importance of this income tax and scope of this income tax if you are getting ready for the NET examination. And I want you to understand that how many questions you need to expect from this income tax subject when you are preparing for the NET examination. I happen to make an analysis of last 10 years question paper of both NET and KSET, and the analysis says that when it comes to NET examination, when it was the examination held in December 2020, as the examination was held in 2 shifts due to the COVID-19 pandemic, in the first shift, 7 questions were asked from income tax. As each question carries 2 marks, the total weightage was 14 marks. Again, in the second shift, December 2020 second shift, 7 questions were asked from income tax. As each question carries 2 marks, the total weightage was 14 marks. Again, 2019, 7 questions were asked. Each question carries 2 marks, the weightage was 14 marks. And again, same can be said about the June 2019, that 7 questions were asked from the income tax, each question carries 2 marks, and the weightage was 14 marks. I mean to say, if you are writing NET examination, the number of questions which you will get in the examinations are 7, and total marks which you need to invest in the income tax subject is 14 marks. And when CBSE was conducting the NET examination, they were asking only 5 questions from the income tax. But from that time, this National Testing Agency has taken over the charge of conducting the examination. They have given they are giving more importance to this income tax subject, and they are asking 7 questions. And if you look into KSET examination, Karnataka State Eligibility Test, all the years, believe me, you will have 10 questions from income tax. And I can tell you the question numbers as well in the second paper. In the second paper, the commerce paper, the question number 91 to the 100 question, the 10 questions what you will have completely will be from income tax. 10 questions you need to expect in the KSET examination. As each question carries 2 marks, the total weightage would be 20 marks. And believe me, 14 marks is not a smaller margin. 20 marks is not a smaller margin. 14 marks is a very big number. 20 marks is a very big number. And many times when the candidates don't, when the candidates are not at all eligible to this NET and KSET examination, they don't lose the eligibility by 20 marks, 30 marks, or 40 marks. Many candidates loses the eligibility by 2 marks, 4 marks, 6 marks, and 8 marks. And when you ask the candidates who have been trying for this NET examination and KSET examination from many years, they'll tell you the importance of 14 marks. They'll tell you the importance of 20 marks. So by looking into this analysis, going into the NET and KSET examination and JRF examination, income tax happens to be an important area, and it is a subject where you must make an investment. It is a subject which you just can't miss out, and it is a subject which is must learn, and as well as it is can't miss subject. And to speak about this income tax subject, today we have 2 hours of duration. What exactly I will do is, in this 2 hours of duration, I will divide this session into 2 parts. In the first half of the session, I'll just try to highlight some of the important aspects, some of the important concepts which you need to go through if you are preparing for the examination. I'll tell you, I'll just try to highlight some of the elements where you need to expect the questions in the examination. And the second half of the session, what exactly I will do is, I have taken some 30-40 questions of last couple of years of both NET as well as the KSET examination. The questions which were belonging to the income tax asked in the NET and KSET examination of last couple of years. I'll just try to highlight those 30-40 questions so that you will have a bit of understanding that how exactly the question papers is going to be, and at the same time you will have some amount of ability to understand the difficulty level of those question papers. See, what exactly happens is, in a very big nation like India, especially in a developing nation like India, government has the responsibility of running the nation. Government has the responsibility of fulfilling the needs of the society, and government needs to satisfy the needs and wants of the society. You look into India today, you will find very good roads, you will find very good bridges, you will find government hospitals, you have government schools and government colleges, you have railway stations, you have airports. All these are the national properties. In order to construct these and in order to run and maintain these national properties, government requires huge amount of money. Government has some sources of revenue. Among various sources of revenue, one major source of revenue to the government is tax. Tax is a compulsory payment which has to be paid by every citizen. Don't say that we don't need to pay tax to the government. In fact, everyone is paying tax to the government, because if you recharge your mobile phone for 100 rupees, you will not get 100 rupees stock time. Probably you will get 80 rupees stock time. Where the 20 rupees is going, believe me, out of the 20 rupees, 18 rupees is going to the government in the form of GST. If you go to a showroom to purchase a laptop, you will get a bill, and in that bill you will find GST. You go to a restaurant, you have food, a waiter will bring and hand over the bill to you. In that bill, he will include 5% of GST. I mean to say, everyone is paying tax to the government in India, but only difference is few are paying direct tax to the government and few are paying indirect taxes to the government. Any nation for that matter, any nation for that matter collects the taxes in 2 forms. One is they collect the direct taxes, at the same time they collect the indirect taxes. What are direct taxes? Direct taxes are those taxes which government collects it directly from the citizens, and indirect taxes are those taxes which government collects indirectly. If you look into that definition, direct taxes are those taxes in which incidence and impact will be on the same person. What is the meaning of incidence? Incidence means who is paying tax to the government. Impact means from whose pocket it is being paid. Assume for instance, there is a salaried person by name Mr. X. Mr. X, if his income exceeds a particular exemption limit, he has to pay tax to the government. Who should pay tax to the government? Mr. X should pay tax to the government. So incidence is with Mr. X. From whose pocket he should pay tax to the government? He has to pay from his own pocket. So the impact is also on Mr. X. When Mr. X is paying tax to government, incidence is on Mr. X, and when he's paying from his own pocket, impact is also on Mr. X. So we can call it as direct tax. If you look into indirect taxes are those taxes wherein which incidence will be on one person and the impact will be on another person. For example, you look into the GST, you look into customs duty, you look into sales tax. Assume you purchase a commodity today. The seller, the retailer or the wholesaler who is selling you the commodity, he should pay GST to the government or he should pay sales tax to the government. When he's paying sales tax to the government or when he's paying GST to the government, he will pay GST to the government. Retailer is paying GST to the government. Incidence is with retailer, but he don't pay from his own pocket. He will collect it from the ultimate customer. So the retailer is paying tax to the government, but he is collecting it from the ultimate consumer. So incidence is on one person and the impact is on another person. We can call it as indirect taxes. In the past, in the direct taxes, majorly we had two types of taxes. One, we had income tax, and later on we had wealth tax. But in the year of 2016, when the budget was announced, finance minister, in the sense, when the budget was announced, government abolished the wealth tax. And today, if I speak about direct tax, in the practicality, majorly, we have only one tax in the market. We have one tax in the nation, that is income tax. And if we speak about the indirect taxes, before 2017, we had 20 plus indirect taxes in India, but the government was having a lot of difficulty in managing and regulating the indirect taxes because, on manufacturing, there was one tax, on sale, there was one tax, when you're exporting, there was a different tax, on entertainment, there was a different tax, service, there was a different tax, off trade, on entertainment, there was a different tax. Government was having a lot of difficulty in managing and regulating all these taxes. We need to have a different law, we need to have a different act, we should have many acts, we should have a separate act for all the each and every tax. Government said that we will abolish all the indirect taxes. In place of all the indirect taxes, we have to bring only one tax. For that reason, government had spent nearly 17 to 18 years. And finally, on 1st of July 2017, government was successful in implementing GST in India. So when GST was implemented in India, believe me, your 70 to 80% of indirect taxes are subsumed under GST. And today, if I speak about indirect taxes, majorly you will find GST. Apart from GST, you will find customs duty, and you have other taxes like electricity. You have, some other taxes. We have like still some sales tax is continuing on the petroleum product and alcohol and all state. Some taxes are still in existence, but major taxes have come under the umbrella of GST. So direct taxes, there were two major taxes of income tax and wealth tax, but today majorly you will find only one tax. That is what is income tax. And indirect taxes, GST, customs duty, sales tax, electricity tax, these are the taxes we have. And indirect taxes is not the area to speak about for the day. It is only about the direct tax. And under the direct tax, as I told you, that there's only one major tax we have in the market today, and that is what is income tax. So before understanding any tax for that matter, we have to understand the law behind it. Because if you don't understand the law behind it, you cannot understand and you cannot have a complete clarity about the particular tax for that matter. In India, whatever the direct taxes we have, in India, whatever the income taxes we have are gone, these are regulated by 6 major laws which we have in India. And the first and foremost law for the income tax is the Income Tax Act of 1961. See, look here, in India, taxation is not a new concept. In fact, it is a very old concept. Even during ancient period, there was a concept called as tax. Many kings used to collect the taxes from their residents. They don't used to collect in the form of cash itself, like how government collects it today. At that time, many kings used to collect the food grains from their residents in the form of tax. Taxation is not a new concept. In fact, it is an old concept. But when exactly the concept of tax originated in India, it was during 18th century and 17th century. All of you are aware of the fact that Europeans had entered our nation. They entered our nation for the purpose of doing some trading activity. But France entered our nation, Italy, Netherlands entered our nation. At the same time, Portuguese entered our nation, and 1600 Britishers entered our nation. England entered our nation. When Britishers entered our nation in 1600, they entered only for doing some amount of trading activities, but they stayed in our nation for a period of 350 years. They ruled our own nation. They rule our own people. And during this period of 350 years, our ancestors, our forefathers, they tried everything to send the Britishers out of India. And during the course of this, many of the freedom movement took place, like Jallianwala Bagh took place, Quit India movement took place, non-cooperation movement took place, Salt Satyagraha took place, like that. Like this, one important movement which took place in India was the first war of Indian independence, or Sipahi Mutiny, which broke out in 1857. War broke out in 1857. The war broke out between Indians as well as the Britishers. War went on for a period of 4 years. War came to end in the year of 1860. When war came to end in 1860, war went in favor of the Britishers. But even though Britishers won the battle, both the parties, I mean the Indians as well as the Britishers, incurred huge amount of losses. Food problem went up, poverty problem went up, unemployment problem went up. Both the participants lost their treasury. At that time, Britishers thought of refilling their treasuries. Britishers thought of overcoming the food problem. Britishers thought of overcoming the unemployment and poverty problem. At that time, there was a officer in British East India Company by name James Wilson. James Wilson came up with an idea, and he came up with a system, the system of collecting small amount of money from people of India. And for that system of collecting small amount of money from people of India, he gave a name called as tax. From that time, 1861, James Wilson started a tax in India. From that time, we had the concept of tax formally. But even though it was introduced, it was not like, everyone should pay tax to the government. It was not mandatory for the citizens. It was not compulsory for the citizen. And later on in 1922, a separate Income Tax Act of 1922 was enacted. And again, 1947, when we got the independence, after that, government thought that we should not depend on the pre-independent acts. We should have our own act. We should have a new act. For that reason, in 1961, Government of India enacted an act called as Income Tax Act of 1961. And today in India, for all the income tax activities, for all the income tax authorities, for all the income tax department, for all the taxpayers, Income Tax Act of 1961 is supreme. And everyone should follow the rules and regulations laid down in the Income Tax Act of 1961. What this Income Tax Act of 1961 says, this Income Tax of 1961 tells you what are your incomes, what are your not your incomes. What are your expenditures? What are not your expenditure? Why? Because, normally government income tax has its own rules. Whatever the incomes you are earning doesn't become incomes, in the eyes of the law. Whatever the expenses you have doesn't become expenses in the eyes of the law. Because in the business, what you earn is real income. But government says you don't need to pay that tax on real income. You have to pay tax on taxable income. Government says some incomes are admissible, some incomes are not admissible, some expenses are admissible, and some expenditure are not admissible. That is what you will find in Income Tax Act of 1961, that which are income in the eyes of the law, which are not incomes in the eyes of the law. So the first and foremost law what we have is Income Tax Act of 1961. And the second important law what we have is, Income Tax Rules of 1962. Look at this Income Tax Rules of 1962 gives you a lot of provisions, like it gives you forms, it gives you applications. For instance, income tax gives the different rates for charging of the depreciation. Normally in the companies, as per the Companies Act, you will charge different rate of tax, different rates of depreciation. But income tax asks you to charge different rates of depreciation. For that reason, it has block of assets. All the rates of depreciation what you will find it in Income Tax Rules of 1962. And apart from that, if you are a charitable institution, you don't need to pay higher amount of taxes. You have to pay smaller amount of taxes. But at the end of the year, you need to make an application to the income tax department, but saying that I am a charitable institution. Where you will get that application, where you will get that form you will get in Income Tax Rules of 1962. And apart from that, at the end of the year, you need to furnish your auditor's report by saying that there are no loopholes in the annual reports. Whatever the profit you have calculated is exactly right. Whatever the cash position you are showing in the business is exactly right. Auditors will report it. Auditor will prepare report. The report format we have, again the format you will get in Income Tax Rules of 1962. And again, the third important rule what we have is the Finance Act. What exactly happens is, as the time passes, lot of things changes. As the time passes, prices of the commodity increases, income of the people increases, standard of the living of the people increases, purchasing power of the people increases. When everything is changing, government says that there is a need of bringing some changes in the taxation laws as well. For that reason, every year government prepares a budget. In the month of February, in the past government used to present the budget on the last day of February, but from last 4 or 5 years, especially under this government is presenting the budget on the first day of February, and this budget is an estimation of all the revenues and expenditure which you will have during one particular year. And apart from the estimated revenue and expenditure, major changes it brings in the economy. It brings lot of changes in the taxation. It brings lot of amendments in the taxation. Like, you know, income tax rates would be changed. Some incomes may be exempted, some expenditures may be allowed, some deductions may be provided, some losses may be allowed you to set off. Some changes will be brought in this Finance Act. So this is also an important law when it comes to the income tax. Next, as the time passes, what exactly happens is government thinks that if we need to bring a temporary rule, for that reason, government brings a notification. Government announces it in a newspaper. Government telecasts it in the on the national channel or maybe on the state channel. For example, you know, suddenly government may bring a temporary rule that whatever the food grains you are purchasing on street, you're not paying tax to the government. You're not paying any tax to the government. But tomorrow, 7th of April 2021, whatever the food grains you purchase on the street, you need to pay 5% of tax to the government. And it applies only for tomorrow. Government may bring this temporary rule through a notification. Otherwise, you know, for instance, on petrol, GST is not applying. Older sales tax is being applied. Government may say that only tomorrow for 7th April 2021, wherever you are in India, if you are buying petrol of 1 liter, 5% of GST you need to pay. And it applies only for tomorrow. It may not apply for day after tomorrow. What exactly happens? Government may bring a temporary rule in the form of notification. Next, circular and clarification. Believe me, in India, we have various acts. We have Consumer Protection Act. We have Contract Act. We have Partnership Act also we have. At the same time, we have Companies Act of 1956 and Re-Amendment Act of 2013 we have. But believe me and trust me that among all the acts what we have in India, Income Tax Act is considered as the most complicated act, and income tax rules are considered as the most complicated because these are most dynamics. This keeps on changing. Many times what will happen whenever government brings a notification, people will have a lot of difficulty in understanding those rules. For that reason, when people don't understand it, what government does? Government gives the clarification. Government gives what? Clarification. At the same time, whatever the information needs to be furnished, whatever the information needs to be circulated between the taxpayers, government brings it through circular. For instance, you know, last year, as it was considered as a pandemic year, the last date for filing the income tax returns were extended. And how it was extended, how people came to know that the date is being extended, Income Tax Department had given the circulars. And in India, Government of India, under Government of India, we have various portfolio of ministries, like we have Ministry of Transportation, Education Ministry, we have Defense Ministry, we have Railway Ministry, we have like that. One important ministry we have is Ministry of Finance. Under Ministry of Finance, we have two major departments. One we have Department of Revenue, one we have Department of Expenditure, and under Department of Revenue, we have Central Board of Direct Taxes, and Central Board of Direct Taxes governs this direct tax laws what we have, and it gives the circulars, it gives the clarification. Next again, then what exactly we have? Jurisdiction. As I told you that income tax laws are most complicated. Many people will fight that. Suddenly, you know, government may say that this is not your income. Suddenly government says that this is not your expenditure. For that reason, many of the people will file the cases in the court. And when judgment comes in favor of the individual, then it applies to all the taxpayers in India. That rule, particular rule, what we have, we call it as what? Jurisdiction. I mean to say, whenever an individual files a case against a particular notification or circular, when a Supreme Court or when a High Court gives the judgment in favor of that the assessee or the taxpayer, it doesn't apply only to him. It applies to entire India, and the judgment which has come from Supreme Court or High Court, that becomes what here? Jurisdiction. So these are the major 6 laws what we have, which governs the direct taxes in India. Next, moving ahead. You need to expect at least 1 or 2 questions from the basic concepts. When we speak about basic concepts here, you look into any act for that matter. Section 2 speaks about the basic concepts. Section 2 speaks about the basic concepts. So in the Income Tax Act of 1961, whatever the Section 2 we have, it speaks about all the basic concepts of what? The income tax. You know, the first definition what we have is that the person, under Section 2, subsection 31. I suggest you to look into section as well, because you may have the questions from sections as well. See, a person is someone who can pay tax to government. Not that he should pay tax to the government. A person is someone who can pay tax to government. Who can be a person? An individual like me and you can be a person. A firm can be a person, a limited liability partnership can be a person, a Hindu undivided family firm can be a person, then a joint stock company can be a person, artificial person, or something like local authority can be a person, or body of individual can be a person. Person is someone who can pay tax to the government, and there is a category of 6 to 7 to 8 we have, like individual, HUF, company, firm, a body of individual, association of person, limited liability partnership. Next, assessee under section 2 subsection 7. Assessee is a person who is liable to pay. Person means who can pay tax to government. Assessee means who should pay tax to government. And assessee is a person who is liable to pay tax to the government. No, are you a person? Yes, all of you are person. Even if you are paying tax to government, even if you are not paying tax to government, you are a person, because you can pay tax to government. Are you an assessee? It depends. If you are liable to pay tax to government, then you become an assessee. If you are not liable to become an, if you are not liable to pay tax to the government, you doesn't become an assessee. All the student participants who are joined us today, they are students. They are not having regular income. They are not having salaries. They are not getting regular income. Their income is not exceeding a particular exemption limit. They don't need to pay tax to the government. All the students are person, but they are not assessees. Why? Because they are not liable to pay tax to the government. Next, deemed assessee, a person, who pays tax on behalf of others. For instance, there is a minor and a huge amount of property has been registered under his name. He cannot pay tax to the government. On behalf of him, a major will pay tax to the government. Assume there is an individual. He is residing in Australia. He cannot come to India. He is having huge amount of property in India. He's having houses. He's getting the rent and all. He need to pay tax to the Indian government, but he is in USA. On behalf of that person who is residing in USA, someone should pay taxes in India. And the person who pays tax on behalf of other person, he called as what? The deemed assessee. Next, assessee in default. When you speak about assessee in default, if you are liable to pay tax to the government, but if you are not paying tax to the government, you becomes assessee in default. A person who files to pay tax to the government. Assume you need to deduct TDS. You need to deduct TDS and you need to pay to the government, but you are not deducting TDS and you're not paying to the government. You becomes what? Assessee in default. Person who can pay tax to government, assessee who is liable to pay tax to the government, deemed assessee who pays tax on behalf of another. Next, assessee in default, a person who files to pay the taxes to the government. Next, see, income tax is an annual payment. What you have to do is you have to calculate the income for one particular year. Whatever the income you earned in this particular year, you have to pay tax in the next year. And when you will come to know your annual income, at the end of the particular year, you will come to know your annual income. What government says is, you earn the income. You earn the income. You earn the income at the end of the year, at the end of an accounting year, at the end of the financial year. That is from 1/4/2020 to 31st March 2021. You calculate your total income, and for this year income, you pay the tax in the next year. You pay the tax in the next year, and the year in which you are earning the income is called as previous year, and the year in which you are paying tax to the government, that year is called as what? The assessment year. Why? Because income tax is an annual payment. You will not come to know your annual payment at the middle of the year or maybe at the ending stage of the year. You will come to know your annual income only at the end of a particular year. What you should do is, you have to earn the income for 1 year. After computing the total income of that particular year, you have to pay tax in the next year. The year in which you earn the income is called as the previous year, and the year in which you pay the tax to the government is called as what? The assessment year. And for us, believe me, we have if I would have taken this session last week, for us, I would have told you a different assessment year and I would have told you a different previous year. But we have already entered the month of April. From Thursday, we have entered the month of April, and for us, the assessment year is 2021 and 22. For us, the previous year is 2020 and 21. Next, see, if you need to pay tax to the government, I think I need to move ahead quickly because already half an hour up, and I have not done even 2% of the discussion what I need to make. See, when we speak about tax liability, if you are liable to pay tax to the government, if you are paying tax to the government, how much of tax you have to pay to the government? It depends on 3 things. It depends on 3 important things. It depends on your residential status. It depends on type of income. It depends on incidence of tax. How much tax you have to pay to the government? It depends on three things. It depends on residential status. It depends on the type of income. Then it depends on what? Incidence of tax. What's the meaning of residential status? Residential status means how many days you are staying in India. Normally, what exactly if you are an Indian, if you are not an Indian, we ask for the citizenship. Government of India asks you the citizenship. But when it comes to the income tax, citizenship doesn't matter. Income tax laws ask you to prove your residential status. Residential status means here your stay in India during the previous year. Next, type of income. Your type of income can be two. It can be an Indian income or it can be an the foreign income we have. Next, moving ahead. When we speak about the residential status in India, if you are an individual, you can be a resident and ordinary resident. When it comes to residential status, you can be a resident and ordinary resident. You can be a resident but not ordinary resident, and you can be non-resident. Three categories you have, and believe me, you need to expect one question from this concept. You can be a resident and ordinary resident. You can be a resident but not ordinary resident, and you can be a non-resident. So who becomes a resident? Who becomes resident but ordinary resident, not ordinary resident? Who becomes a non-resident? For that reason, you have to look into some amount of conditions. See here, there are two types of conditions you have. One is your basic condition, and later on you have something called as what? Additional condition. You look into basic condition. First basic condition is that you should stay in India for a period of 182 days. You should stay in India for a period of 182 days in the previous year. Previous year means starting from 1/4/2020 to 31st March 2021. If you are staying in India for a period of 182 days in the previous year, relevant previous year, then you are satisfied your first basic condition. Next, again, the second basic condition is that you should stay in India for a period of 60 days in the relevant previous year. Not only 60 days in the relevant previous year, apart from 60 days in the relevant previous year, you should stay in India for a period of 365 days during 4 years, except the previous year, preceding the previous year. I mean, except the previous year, before that 4 years, whatever you had, you have to stay in India for a period of how many years? 4 years. These are the two basic conditions what you are having. And the staying in India for a period of 182 days is the first basic condition, and staying in India for a period of 60 days and 365 days in the last 4 years preceding the relevant previous year is your second basic condition we have. Next, come to the addition condition. Under the addition condition, the first addition condition is that you should stay in India for a period of 2 complete years out of the 10 years preceding the relevant previous year. If you are staying in India for a period of 2 years out of the last 10 years except the previous year, then you are satisfying the first additional condition. Then coming back to the second additional condition, what we have, you should stay in India for a period of 730 days in last 7 years. You should stay in India for a period of 730 days in the last 7 years preceding the relevant previous year. And if you are staying in India for a period of 730 days out of the last 7 years except the previous year, then you are satisfying your second additional condition. And believe me, I'll come back to this again, but just have a look into this. Look here. If you are satisfying at least one basic condition, if you are satisfying at least one basic condition and both the additional condition, you become unresident. You become unresident, and not only that, apart from resident, you become an ordinary resident. If you are satisfying at least one basic condition and both the additional conditions, if you are satisfying, you become a resident and also you become ordinary resident. And if you satisfy at least one basic condition, you are satisfying at least one basic condition, but you are not satisfying any of the additional condition, you are still resident. You are still resident, but you are not ordinary resident. You are not ordinary resident. And the third point is that if you don't satisfy any of the basic condition, if you are not at all satisfying any of the basic condition, there is no need to look into the addition conditions. When you fail to satisfy any of the basic condition, by default, you become non-resident. So you must have gone through in all your degree levels and all. And if you are a faculty, you must have taught income tax subjects to the student and all. You are very much aware of the fact that if at least one basic condition is satisfied and two additional conditions satisfied, you become resident and ordinary resident. If at least one basic condition is satisfied and none of the additional conditions is satisfied, you become resident, but you are not ordinary resident. And if none of the basic conditions are satisfied, you become non-resident. And I want you to make and put one point in front of you, and I want you to remember, I want all of you to remember this. because this is a latest amendment and this is a recent amendment. And believe me and trust me that whenever there is a recent amendment, whenever there is a recent changes in the taxation laws, the chances are more that you would get questions in the examination. So this year, this year means what? Assessment year 2021 and 22 what we have. This small amount of change has been done. Okay, this second condition what we are having, second condition, I spoke about 60 days. I spoke about 60 days, but there are some cases, this 60 days become 120 days. This 60 days become 120 days, and there are some cases when this 60 days become 182 days. I repeat it once again. But this and believe me, if I was speaking to you in the last week, if I was speaking to you in the month of March, I would not put this point in front of you, because this applies from 1st of April this month. This financial year what we have entered on Thursday, this rule applies from this assessment year. There are some cases wherein which this 60 days become 120 days. And there are some cases when this 60 days become how many days? 182 days. When it becomes 120 days, if there is an citizen of India, if there is an Indian citizen who lives in India and he goes to other nation for the purpose of employment. If there is an individual who goes to other nation for the purpose of employment, then 60 days doesn't apply to him. Instead of that, how many days will apply to him? 120 days will apply to him. First point. To whom 120 days applies? A person who is going abroad for employment. If a person is going for a foreign trip, rule doesn't apply. If a person is going for search of employment, doesn't apply. If a person is going to visit his or her relatives, rule doesn't apply. If a person is going for employment, this rule will apply. Instead of 60 days, 120 days. Again, one more situation is that if a member of crew of a ship, I tell you this. See, what exactly happens is, ocean transportation is considered as one of the lengthiest transportation. See, if a ship is moving from India to, let's say, for example, USA, it takes months together to reach USA, and it takes months together to come back to India. So some captains of the ship, some marine engineers, some sweepers of the ship, some cleaners of the ship, some mechanics, some electricians who stays, in the ships and all, they need to spend 100, 200 days out of India. Government says that if you are a member of crew of a ship, if you are moving from India, if you are a member of a crew of a ship, you don't need to satisfy 60 days. In order to call as a resident, you need to satisfy how many days? 120 days. So two things where 120 days will apply. If you are leaving India for the purpose of employment, 120 days will apply. If you are a member of a crew of a ship, again 120 days will apply. Again, to whom 182 days apply? If you are leaving India for employment for the first time, if you are leaving India for employment for the first time, 182 days will apply. And if you are a member of crew of a ship, and if you are leaving India for the first time, again 182 days will apply. Here you don't need to look into 60 days. See why government has done this. Government needs to give some amount of benefits to the taxpayer. See, now if I ask you a question that, do you want to become a resident or do you want to become a non-resident? Believe me, becoming non-resident is good for you. Why? Because if you become non-resident, many incomes you don't need to pay tax. Many incomes you don't need to pay tax. If you are a resident, no. Even on the foreign income, you have to pay tax to the government. But if you are a non-resident, you have to pay tax only in the Indian government. So, is it advantage to the taxpayer or is it advantage to the government? Definitely, this is an advantage to whom? The individual, not to the government. So, you go through with this. There are chances that you could expect this question in the examination. That in the examination, what kind of questions you can expect? You need to expect a question out of basic condition, revised basic condition. You need to expect questions on additional condition. Then again, who is called as a resident or ordinary resident? Who is called as a resident but not ordinary resident? Who is called as non-resident? You can expect questions out of this. Again, they may give a case to you. and they may tell you that Mr. X entered India on this day, he stayed for a period of these days, he's left India for this number of days, again came back to India, stayed for this period, at the end of the year, what is his residential status? You need to expect question on this. Next, again, I need to move forward. I'll just speed up. Look at when it comes to the type of income, there can be two types of income. There can be an Indian income and there can be foreign income. Indian income is an income which is accrued, earned and received in India. And if it is an income, all the three residents will pay tax to government. All the three residents will pay tax to the government. If it is a foreign income? If it is foreign income, only resident and ordinary resident need to pay tax to the government. And there are some cases where resident but not ordinary resident also needs to pay tax to the government. See, what is the reason behind this? When it is an income, government says no matter who you are, you know, doesn't matter whoever you are, even if you are a resident, non-resident, not ordinary resident, if it is an Indian income, you have to pay tax to the government. You have to pay tax to the government. But if it is foreign income, if you are a non-resident, don't pay tax to the government. You pay tax only if you are a resident. And some cases, even if you are a non-resident, you have to pay tax to the government. So Indian income, all the three parties are liable to pay tax to the government. When it comes to the foreign income, only two are liable to pay tax to the government. Next, look at the world of income tax is very big. The world of income tax, as I told you that under indirect taxes, we have multiple taxes, but under direct taxes, we have only one major tax, that is income tax. The world of income tax is very big. For easy understanding, for easy clarification, Government of India has classified the income tax into 5 major heads. If you are, income from salary, if you are getting an income where there is a relationship between the employer and employee, you need to record the income under income from salary. And if you are having a house, if you are getting a rent from the house and all, whatever the income you are getting due to the house property, you need to record it under income from house property. If you are an individual, if you are a businessman, if you are having a company, if you are having a firm, if you are a cooperative society, even if you are a trust, you need to record your income under profit and gains from business and profession. If you are a doctor, if you are a lawyer, if you are a chartered accountant, you need to record it under what? The profession we have. Again, if you are selling your property, if you are getting the income out of the sale of the property, the income whatever you will get, then you have to record it under capital gain. Next, apart from these 4 heads, if you are earning income, if you cannot drop it in the 4 heads what you have in the above, like winning from lottery ticket, casual income, winning from horse race, betting, gambling, all these incomes you cannot record here. You need to record it under income from other source. Next, we have, look at agriculture income. You go through the section of agriculture income and you understand what is the meaning of agriculture income. Then you understand what could be the examples of agriculture income, because in the examination 4 incomes may be given to you and you would be asked out of this which is an agriculture income and which is not an agriculture income, or even you may be asked about what are the conditions to call it as an agriculture income. Look here, when we got independence in 1947, at that time more than 50% of population was dependent on agriculture. At that time government said that whatever the income farmers are earning from agriculture, we don't need to ask them to pay tax to the government. So from that time, even today, whatever the income you are earning by way of agriculture, there is no tax. There is no tax. It is exempted from taxation. But believe me and trust me that from last few years, a question is being raised in the parliament. A question is being raised in the finance commission that even the agriculture income needs to be taxed. Recently, some 5-6 days ago, the income tax department, let me omit the name of a particular state, and they have raised a question that many of the large farmers, they are taking the benefit of this and they are not paying tax on the agriculture income. So it is been discussed and it has been said that if you are a large farmer, you have to pay tax to the government. If you are having hectares and hectares and hectares of land, if you are growing agriculture produce, you need to pay tax to the government. And if you are a smaller farmer, you don't need to pay tax to the government. Next, again, clubbing of income. Look here, you can expect the questions on, various sections of clubbing of income. What exactly happens in India is many people escape from paying tax to the government. We are a human being. We like cash inflows. We don't like cash outflows. Many people say, escape from payment of tax to the government. Let me tell you the section, how exactly government has made the sections in the clubbing of income. You will be stunned to know, you will be surprised to know that, many times what an individual will do, individual will tell that I am paying tax to government. There is an income, but this is not my income. This is someone's income because I have transferred the income. Now government says you have transferred the income now, but whose asset is this? It is your asset now. You have transferred only the income, but asset, you are the owner of the asset. Government says as you are the owner of the asset, it is not someone's income. It is your own income. Club it and pay tax on that income as well. Again, sometimes what you will do, you will transfer the income to others and you will transfer the asset to others also. Temporarily, not permanently. Government says it is your asset now. It is your income. You have transferred the income to the others. You have transferred the asset to the others temporarily. But it is your asset. It is your income. Even though someone else is receiving, even though someone is holding for temporary tenure, it is your income and it is your asset. You total it, you club it, you merge it in your income and pay tax to the government. Again, some people, what they will do, they will transfer the asset and income to their spouse. They will transfer the income and asset to their wife. Government say, and you will tell that I will not pay tax on this income because it is not my income, it is my spouse income. Government says we have a section for this. We have a section for this. Government says it is your wife, it is your spouse income. No, it is your spouse asset. No, you are transfer the income and asset. But assume it is your income, assume it is your asset, pay tax to the government. Again, this comes under what? Clubbing of income. Next, if you transfer a particular asset just to avoid the payment of tax, again it comes under what? Clubbing of income. You have to club it and you have to pay tax to the government. Next, look at Indian taxation system is very much helpful to you. You need to expect a question out of setup and carry forwards as well. That whatever the losses you make in the previous year, or even whatever the losses you make in this year, government gives you the benefit of setup. For example, you are having two houses or you are having two businesses. One business is making profit, one business is making loss. Government says one business is making profit. No, don't pay tax on the entire profit. Whatever the losses you made from another business, you set up those losses in the profit-making business. After it, whatever the profit remains, you pay tax to the government. This is called a set-off of losses. And if you are having one house, and if you are having two houses, one house gives you the profit, one house gives you the income, another house gives you the losses because you have taken huge amount of interest for construction and renewal. Government says that one house is giving you income, one house is giving you the loss. Don't pay the tax on the income. First, you set up the losses which are from other house, you set up it and pay tax to the government. So this kind of concept is called as set up of losses. So there can be two types of setup here. House one loss, you are setting up from house to income. This is called as intrahead. Business one loss, you are setting up against business to income. This is called as intrahead setup. Interhead setup means that from the income of the loss of one head, you are setting up from the income of another head. For instance, the short-term capital loss what you are having, you are setting up from income from house property. This one head loss, you are setting up from another head loss. It is called as what? The interhead setup. Two types of setups here. Next, again, some points I want you to remember. Look here. Loss from speculative business. Speculative business means if you are into investment, if you are into investment of shares, debentures, and mutual funds, you are called as speculative business. Loss from speculative business, you cannot set off against any other income. You have to set off only against the income from speculative business. Next, loss from specified business. Loss from specified business under section 35 AD. If you are doing a specified business which is in section 35 AD, you cannot set off against any other income. You have to set off the loss of this business only against the income of a specific business which falls under section of 35 AD. Which are the businesses falls under section 35 AD? Your storage facility, cold storage businesses, hospitals which have the 100 beds. Then again, hotels of 2-star and above, all these businesses falls under specified business. Next, long-term capital gain, what we have? Long-term capital gain can be very big. You cannot set off long-term capital. No, long-term loss, whatever the long-term loss we have, long-term loss can be very, very big. Long-term loss you cannot set off against any other income. Long-term losses you have to set up only against a long-term capital gain. Again, look at loss from activities of owning and maintenance of horses. You cannot set up against any other income. You have to wait for the income of owning and maintenance of horses. You have to set up against this. Next, loss from exempted income cannot be set off. Assume agriculture income is exempted, but whatever the losses you are having from agriculture income, you cannot set up against any of the income. This one thing you keep it in mind. Next, coming back to the carry forwards. Carry forward of losses. Whatever the losses you have from house property, you can carry forward for 8 years and set off in the next assessment. Yes. If you are having loss from speculative business, if you are having loss from non-speculative business, you can carry forward it for 8 years. Loss from speculative business, only 4 years. Loss from specified business, 35 AD section what we have, you can carry forward it for any number of years. You can carry forward it for n number of years. Next, loss under capital gain, you can carry short-term capital loss and long-term capital loss. You can carry forward for a period of 8 years. Next, loss from owning and maintenance of the horses, you can carry forward for a period of 4 years. Again, look at if you don't have the profit to charge the depreciation, you can still carry forward in the next year. You can charge this year depreciation in the next year. And in provision we have that previous year depreciation you can charge up in the next year, but you can carry forward only for a period of 8 years. Next, I suggest you to go through with the setup and carry forwards, because you need to, what are the types of questions you can expect here? Intra-head, inter-head, what losses can be set off against what losses, you need to have a knowledge of this. Then period of setup you need to go through. See, everything is 8 years, but speculative business is 4 years. Another loss from owning and maintenance of the horses is 4 years. Then a specified business is 8 years, infinite period. I suggest you to go through with this. Next, you need to expect at least 1 or 2 questions from deduction. You must expect a question from deduction. See, what exactly the concept of this deduction is. If I ask you a question that what is tax, many of you may say that tax is a revenue to government. Tax is a revenue to government. But believe me and trust me, tax is not only revenue to government. I tell you, tax is a tool for development. Tax is a tool for growth. Many times, what happens when government thinks that a particular sector needs to be developed, government brings tax laws in that particular sector. Government makes taxation rules and government changes the taxation rules in that particular sector. When government changes the tax rules of that particular sector, suddenly that particular sector will start to develop. For example, for instance, till 1995, in India, we had only one telecommunication company. That was BSNL. That too, they were providing, landline services. After 1995, before that and after 1995, government thought that we have to develop the telecommunication sector of India. For that reason, government brought one rule. You know what government brought? Government brought one rule by saying that if any business starts up a business of telecommunication sector company in India, they can start up the business, make super amount of profit, but they don't have to pay the taxes for a period of certain years. When government brought this rule now, then to save the taxes, to get the benefit of tax holidays, everyone started to enter into telecommunication. Then your Airtel company was established, Vodafone company, Tata Docomo, Uninar, Vodafone, Aircel, all these companies were established. And today, we are standing in 2021. India's telecommunication sector is one of the largest sector of the entire world. And especially after Reliance Jio, that we have gone a very, very far way. That communication system of India is one of the biggest in India, and you can understand it. But just by looking into a common man, that every individual uses at least 2 numbers or 3 numbers. Till 1994 and 1995, we don't have many IT parks in India. We don't have many IT companies in India. Government said that we have to improve the IT parks in India. For that reason, government brought a circular by saying that if anyone start up a IT park in India, they can start up a IT park, they can run a IT park, they can operate a IT park, and they can make super amount of profit, and they don't have to pay the taxes for a period of certain years. When government brought this rule, then everyone started to enter into the venture of developing, operating, and establishing the IT parks. And after that, 1994 in Bangalore, 1995, your ITPL of Whitefield was established. 1998, your Bagmane Tech Park was established. 2001, your Manati Tech Park was established. And today, Bangalore's IT parks are one of the best in the entire world. This is how government ensures development. This is how government ensures development. Till 2000, 2001, India's retail sector was not much developed, especially the organized sectors like Big Bazaar, malls, more whatever we have organized retail sector. It was not much, established. Government said that we have to improve the retail sector of India. For that reason, government brought a circular. You know what government said? Government said that whoever comes forward to start up a shopping mall, multiplex, organized retail sector, they can start up a retail sector, they can make the profit, and they don't need to pay the taxes for a period of certain years. When government brought this rule, many people started to establish shopping malls, organized retail sectors. And believe me, when government brought this rule, in the year of 2004, Forum Value Mall of Koramangala was established. 2005, Garuda Mall was established. 2010, Monthly Mall was established. 2012, Orient Mall was established. And today, Bangalore retail sector is second best retail sector after Mumbai in India. This is how government ensures development. You know what government says? Government says that India's tourism is one of the best in the entire world. Because, you know, thanks to the kings and the empires and kingdoms who have left very, very good historical monuments, very, very amazing world heritage. You know, if you visit this world heritage and if you visit this tourist destination, no, you will be amazed to think that in the era of technology, we cannot think of, you know, building the superstructure of those kind. But 200 years ago, 500 years ago, 700 years ago, when there was no technology, when there was no communication, our kings, our kingdoms, our rulers, and our empires were able to build those superstructure. Every foreign individual wants to come to India and he wants to visit the Indian tourist places. You go, you know, you ask Western nations, you ask European nations, and even you ask island nations. They'll tell you that, you know, they want to come to India and they want to visit India and they want to go to the tourist places of India. You know what government says? Government says that when foreigners comes to India, they need hotels to stay. Government says, if you establish a hotel and restaurant near a tourist destination, you establish and do your business and make profit. Don't pay taxes to the government. Don't pay taxes to the government for a period of certain years. And that is the reason today, if you go to some of the tourist destinations today, you will find very luxurious hotels. And whenever foreigners come to India, they find it comfortable to stay in those places. So this is how government ensures the development. I mean to say, don't ever think that the taxation is just a source of income to the government. In fact, tax is a tool for development and government gives a lot of deductions. Government gives a lot of deduction and Indian taxation laws are very, very helpful to the taxpayers. So we have a deduction under ATG, we have a deduction under ATG, and under ATG, we have no limit donation. I mean to say 100% qualifying amount you can deduct and 50% qualifying amount you can deduct. Look here, I just wanted to put this point in front of you that under 50% qualifying limit, we have four. We have Jawaharlal Nehru Memorial Fund, we have Prime Minister Drop Relief Fund, we have Indira Gandhi Memorial Trust, and we have Rajiv Gandhi Foundation. Why I am telling you this is because a couple of years ago, there was one more deduction here, which was under qualifying 50% limit, which was under 50% limit. That was Prime Minister National Relief Fund. There was a deduction named Prime Minister National Relief Fund that was in 2000, that was in 50% deduction list. But government has taken out this and they have put in the 100% qualifying limit. And you may be given a question in the examination that they may ask you a question that identify the 50% qualifying limit, and they may give you one here and they may give you 3 out of this. And sometimes they may give a question like, which among the following is not a 50% deduction list? And they may give you 4. They may give you these 4. If this question was asked some 5-6 years ago, we would have told question is wrong because they have asked us to answer which among the following is not 50% qualifying limit deduction, and they have given 4 options. All the 4 falls under 50%. But standing in 2021, this Prime Minister National Relief Fund, what we have, this doesn't fall under the umbrella of 50%. It falls under the umbrella of 100%. So ATG deduction, I just want you to go through the list of 100%. See, what government says is, government says that sports of India needs to be developed. Donate for sports, you will get deduction. Government says blood camps needs to be conducted. Blood banks, what we have needs to be promoted. Donate to blood banks, will give the deduction. Government says cultural things needs to be protected. Government says you donate to the culture and will give you the tax holidays. It will give you a deduction rather. Then government says that when there is an earthquake, you donate. When there are floods, you donate. When there are droughts, you donate it. So deductions, if you are giving to them, you will get the deduction. Next again, when it comes to the next one, see look here, I want you to remember this at least sections. I want you to remember this at least sections because there were questions asked from these sections as well. See, ATGGA is a deduction if you are giving some donation for a scientific research. What's the meaning of this scientific research? See, scientific research matters the most. Any research for that matters the most. See, entire world spend even today, many of the nations are trying hard to find the vaccines and to go for vaccination for this COVID-19 pandemic. If there is a hospital, if there is a medical research center, if they do research, if they bring tablets, injections, and treatment for a particular disease, government says you give money to them. You give money to them. And you're doing a social cause. You're doing a social cause. We will give a benefit to you. What is the benefit we'll give you? Whatever the donations you are making, we'll ask you to deduct it from your income. And by deducting that income, you pay tax to the government. So 80 GGA is the donation which you will pay you will donate for scientific research. Next, deduction under section 80 GGB. See, if you are on company, if you are making the donation to a political party, then government says you will get the deduction under section 80 GGBB. And again, if you are an individual, see, if you are a company donating to political party, you will get deduction under section 80 GGB. If you are a person, if you are an individual person, if you are making a donation to a political party, then government says that you will get a deduction, but not under section 80 GGB, because you are not a company. You are what? An individual. Then you will get the deduction under 80 section, section 80 GGC. Next, again, see, I want you to go through the list of this 80A, and section 80 IS says that if you are involved, as I told you, that IT parks, retail sector, telecommunication, hotels. See, if you are into infrastructure, if you are starting up infrastructure like construction of roads, bridges, dams, if you are constructing these things, government says you can get the deduction. If, as I go to IT parks, if you are starting up IT parks like ITPL, Bagman Tech and all, you will get a deduction over here. Next, generation and distribution of electricity. If you are into the business of generation and distribution of electricity and reconstruction of power generating, whatever the income you are earning, you don't need to pay the taxes for a certain period. This is what the deductions we have under the section 80 IA. I suggest you to go look into this and at least what are the activities falls under this, you need to go through. Next, look here. Deduction in respect of profit and gains from undertaking engaged in development of special economic zone. See, special economic zone, if you are a business activity, your activity is, you need to develop and you need to maintain the special economic zone, then says you don't need to pay tax to the government if you establish from 31st March 2005. Next, 80 ISC says that deduction in respect of certain deduction in respect of profit and gains from undertaking engage in specified business. See, recently government has brought this section. What government wants is, government wants to promote the startups. Government wants to promote the startups. Government wants to have technological business. Government wants to make innovation. Government wants people to start limited liability partnership. Today the startups are overtaking the older companies what we are. Because, you look into the Zomato, Swiggy and all. Nobody thought that, 10 years ago, nobody thought that, a day will come when food will be delivered to your doorsteps. You look into Ola, you look into Uber, you look into Rapido and all. Nobody must have thought that, instead of auto, we can have a luxury of traveling in a car by paying certain amount of rent. So government wanted to promote the startups. For that reason, government has brought up this. Next, again, see, I just want to run with this because I need to focus on questions as well. 80IB says that if you are into commercial production of mineral oil, see, extraction of mineral oil also matters the most. If you are into the extraction of mineral oil, government says that you will get the tax holidays. If you are in refining the mineral oil, you will get the holidays. If you are in the natural gas, you will get that deduction. Whatever the profit you are making, you don't need to pay the tax to government. If you are in housing product, you develop the residential housing products and all, you don't need to pay the taxes to the government. Next, if you are in the business of handling, storage and transportation of food grains, you don't need to pay the taxes to the government. Next, processing, preservation and packaging of fruits and vegetables, you don't need to pay the tax to government. And if you are a hospital established within this duration, you don't need to pay the tax to government. And there is one more here, not 7, in fact 8 types of businesses we are here. One is, a company who is into the meat, they can also get the deduction over here. I just suggest you to understand which activity falls under which deduction. I know that 80IA and 80IB are vast compared to the others, but there is no other option you need to go through. Next, deduction under section 80IC. Government says that if you are in the special category state, which are the special category states? Arunachal Pradesh and Uttarakhand. Which are the two special category states here? Arunachal Pradesh and Uttarakhand. If you are having a company in Arunachal Pradesh and Uttarakhand, you make how much of profit you want? We will not ask you to pay tax to the government. But condition is that your business should have been established between 6/1/2003 to 1/4/2012. Next, 80ID government says that this is what I spoke about the tourism. No, government said 80ID you will get a deduction. What kind of deduction you will get? Deduction in respect of profit and gains from business of hotels in specified area. Hotels in what? Specified area. Here specified area means World Heritage Centers, tourist destination. Wherever there is a tourist destination, if you start up a hotel, you will get a deduction. Next, 80I. Come back to the 80IA. If you look into 80IA, deduction in respect of profit and gains in certain undertakings in northeastern part of India. See, again, development. There is no point here. Whatever the rule government brings, there is a reason, and ultimate is the development. Northeastern India, northeastern states. See, whatever the states we have in South India, Karnataka, Tamil Nadu, Andhra Pradesh, Kerala, and even, your Goa. If you look into western states, Gujarat, Rajasthan, part of Maharashtra, look into central state, look into northern state, many states are developed. But if you look into the northeastern part of India, what we have, I mean, the states which are very close to Bangladesh, Nepal, Myanmar, Bhutan, some states we have in India, these states are not at all developed. Government says, if you are having a business in Karnataka, you will pay tax to government, but don't have business in Karnataka. You go to northeastern states, you establish your businesses and don't pay the taxes to the government for a period of certain years. And now ask me a question. If you make business in Karnataka, well and good. Why we need to go to the northeastern part of India? Government says that when you establish a company in northeastern part of India, you will utilize the resources of northeastern part of India. You will generate employment opportunities in northeastern part of India. When you generate employment, people will get income. When people get income, they can lead a luxury life. The standard of the living of the people increases. When people get income, they will educate their children. And increase in employment is an economic development indicator. Increase in income is an economic development indicator. Decrease in poverty is an economic development indicator. Increasing standard of the living, increase in literacy rate, educating the next generation is an economic development indicator. Government says that you don't establish a business in south, west, north. You go to the northeastern part of India and you will get certain amount of tax holidays. But the condition is that you should establish the business between 1/7/2007 to 1/4/2017. Here 8 states will come. If you are establishing your business in these 8 states, you will get that, you would have got the tax holidays. Which are the 8 states? Assam, Arunachal Pradesh. Assam, Arunachal Pradesh, Meghalaya, Mizoram, Manipur, Nagaland, Tripura, again Sikkim. Tripura and Sikkim, 8 states we have. If you establish the business in the 8 states, government said will give the tax holidays. Next. After this, 80IE. Next we have come to the second part of the syllabus. Look at first part. You will get one question from residential state. And one more thing, let me tell you. See, the residential state is what I told you, that applies only to individual. But when it comes to company, there can be only 2 possibilities. A company can be a resident and a company can be a non-resident. I'll tell you here. A company can be a resident or a company can be a non-resident. When a company becomes a resident, if it is registered in India, it becomes a resident company. Or if the management is in India, management or control is in India, it becomes a resident company. If the company is an Indian company, if the company is registered in Indian Companies Act, then it is an Indian company, then it becomes a resident company. Or if the management is in India, if the control is in India, what is the meaning of management? important person like board of directors, managing directors are India. Annual general body meeting is taking place in India. Interior meeting is taking place in India. Whatever the branches we have, it is being controlled from the India. If control and management is in India, again it is a resident company. If it is not an Indian company, if the management and control is not in India, it doesn't become a resident company. It becomes what? Non-resident company. So you go through with this individual residential status we discussed. Next, company. This is the company residential status. Then you need to expect one question from agriculture income. You need to expect one question from clubbing of income. You need to expect one question from incidences of taxes. What is the meaning of incidences of taxes? If it is Indian income, taxable in the hands of all three. If it is a foreign income, taxable only in the hands of resident, and some cases taxable in the hands of not ordinary resident as well. Next, come to the tax planning. Second part of your syllabus. See, when we speak about tax planning here, as I told you that, every individual tries to reduce his tax liability. Government says, forget about making an attempt. Forget about trying to reduce the tax liability. Government says, we will give you all the benefits. Government says that if you are doing this, we'll give you a lot of deductions. We'll allow you to do the setup and carry forward of classes. We will allow you to get the rebate. We'll allow you to get the exemption. Trying to get the deduction. See, you want to reduce your tax liability. How you will reduce tax liability? You get the benefit of tax rebate. You get the benefit of deduction. You get the benefit of setup and carry forward of classes. You get the benefit of exemption. If you are doing all these things, then this is called as tax planning. This is called as what? Tax planning. Tax planning is the process of trying to reduce the tax liabilities by being within the law. You should not go beyond the law. You should be within the law, that you should try to reduce the tax liability of your company by, or individual for that matter, by staying within the law. There are some concepts. They may ask you the meaning of this, or they may ask you to, at one side, they may give you these four terms what we have, terminologies, and at the other side, they may give you the meaning of this, and they may ask you to match the following. Look here, what is the meaning of tax management? Tax management means performing your duties on time. You are very much, you are doing everything as per the law. Government says, this is a last date to file the returns. You are doing within that date. Government, you are maintaining proper records. You are doing proper auditing. You are not manipulating your books of accounts. You are not manipulating your sales. You are not manipulating your expenditure. You are not manipulating your vouchers. And you are not manipulating your business. If this, you are doing all these things here, then it is tax management. It is tax management. Next, what is the meaning of tax planning? See, you are, tax management means you are performing everything. You are following the rules and regulations. You are following rules and regulation. Tax planning means you are trying to reduce the tax liability, legally. You are trying to reduce the tax liability legally. For example, as I told you that, government said you can start business in northeastern part of India. You go to northeastern part of India and start your business. You will get tax holidays. See, you are reducing tax liability. Government says it is tax planning. Because you are trying to reduce your tax liability, you are getting the benefit of deduction, you are getting the benefit of exemption, you are getting the benefits of rebate, you are getting the benefits of other things as well. If you are doing this, then your tax liability will come down. Government says you are within the four walls of the law, then it is tax planning. Next, what is the meaning of tax avoidance? See, you are within the four walls of the law, but you are not doing anything on time. You are not performing your duties on time. For example, see, government said August is the last date to file the returns. You did not file the returns on August. Then see, you are not doing anything illegal, but what you are doing, you are not at all filing on time. Government says it is tax avoidance. Next, see, whenever you are making a payment to any person for that matter, you need to deduct the TDS and you need to give it to the government. But you are collected the TDS, but you are not remitted to the government. Government says you are collected a TDS, no. You should have remitted to the government, no. But why you did not remit it to the government? You are avoiding to pay tax to the government. Then it is tax avoidance. Next, what is the meaning of tax evasion? You are doing everything illegal. You are doing everything illegal. For instance, as per the records, as per the registration, you said I will start up agricultural business, but actually you are not doing agricultural business. You are doing other business. It is illegal. As per the records, You should start up a business in Assam. As you get deduction under section 80, northeastern part of India. Assam, you have taken the registration, but you have started a business in West Bengal. This is not as per the law. This is very much illegal. It is called as what? Tax evasion. I just wanted to understand the concept of this and examples of this. Tax management is following rules and regulations. Tax planning is trying to reduce the tax liability legally. Tax avoidance is you are avoiding to pay tax to the government. Tax evasion is you are reducing the tax liability, not legally, illegally. Next, some of the specific management decision. Look here, capital structure. When you want to raise the money, you can raise money from equity. You can raise money from preference share capital. You can raise money from debenture. But believe me, if you raise money from debenture, as per the taxation, if you want to have tax benefits, raise more and more money from debenture. Raise more and more money from debenture. Why raise more and more money from debenture? Because you will have tax shield. What is the meaning of tax shield? Because see, you look into the income statement, you will take sales minus variable cost, contribution minus fixed cost, EBAT minus interest, earning before tax, then tax. I mean to say, if you raise money from debenture, you will deduct tax first. Then you will pay tax to the government. You are going to save tax and interest which you are paying to the debenture holder. Tax planning says that when you are raising the money, you try to raise the money more from the debenture. You will get that. You will get what? The tax shield on. It's a finance term. There is no time to discuss on this. Tax shield on debenture. Next, owner lease. When you need an asset, you have two options. Either you can buy the asset and you can be the owner of the asset, or you can lease the asset. Government says if you are owning the asset, you buy the asset. If you are owner of the asset, you can deduct depreciation as expenditure. Whatever the depreciation you have, you deduct from the profit. Your profit will come down, your tax liability will come down. Next, you have borrowed the asset, you have purchased the asset by taking loans from the bank. No, you are paying interest to the bank. No, that interest is also an allowable expenditure. You deduct the interest from your income in your profit and loss statement. You deduct the interest from your profit. Again, your profit will come down. When profit comes down, tax liability will come down. Government says this is also a tax planning. Then again, if you are leasing, if you are not own the asset, if you are leasing the asset, you are not the owner of the asset. You cannot charge up the depreciation, because to charge up the depreciation, one of the basic conditions is that you should be the owner of the asset. But here, you are leased the asset. You are not the owner of the asset. You cannot charge up the depreciation. But you are giving lease rent. No, you are taken the asset on lease. You are giving the lease rent. Whatever the lease rent you are getting, whatever the lease rent you are paying, you deduct it from your profit. To the extent of that, you will get the tax benefit. You will get the tax holidays. Next, make or buy. When you need a component, option is either I should make this component in my factory or I should buy it from the outside. Taxation says that you make or you buy. Wherever you have good taxation benefit, you do that. If making in company saves your tax, go for making. If buying from outside market reduces your tax liability, don't make. You buy it from the market. This is what is the make or buy. Next, repair or renewal. When you have a particular asset, when you asset become an old asset, options are two: whether you may repair it or you may buy a new asset. Whatever is beneficial for you, you have to do that. If you are repairing, whatever the repair charges you have, it will become revenue expenditure. You can deduct it from profit and loss statement. That much of profitability will come down. When profit comes down, tax liability comes down. Tax planning, you are saving the tax. But if you are going for the renewal, when you want to buy a new machine, you can charge up the depreciation on that. And when you borrow a new machine, you will borrow the loan from the bank. Whatever the interest you are paying to the bank, that much of interest you can deduct from the profit and loss statement. When you deduct from the profit and loss statement, your profit comes down. When profit comes down, your tax liability comes down. Again, tax planning. You are saving the tax. And from tax planning, definitely you will have one question. Next, third part of your syllabus. There are 4 concepts here in income tax. One is the basic concepts. Next, the tax planning. Next, we have something called as TDS. Look here. See, what government says is, if you are making a payment, to a particular individual, you are making payment to someone, you are giving income to someone. It is income in the hands of that individual, and that individual should pay tax to government. It is an income to him. But government says, don't know whether he will pay tax to the government or not. We really don't know whether the person to whom you are making the payment will pay tax to the government or not. So what you do? You are making payment? No. In that payment, you don't make full payment. When you are making payment, you deduct some amount of money, pay it to the government, and balance amount you hand it to the individual. For example, assume we have a coaching institute. In our coaching institute, we bring a national expert to speak about NET and KSET preparation, and he delivers the lecture. Assume, he delivers the lecture for 1 month and 1.5 months. We need to make a payment of 50,000 rupees. When you are making a payment of 50,000 rupees to him, no, you know what government says? See, coaching institute, you are making a payment of 50,000 to an individual. It is an income to that person. Don't know whether he will pay tax to government or not. You do one thing. When you are making payment of 50,000 rupees, you deduct 10%. You deduct 7.5%. For example, 10% you take. 50% of payment you are making now. Out of the 50%, 10% you deduct. 5,000 you take. Give it to government as a tax. And remaining 45,000, you hand it over to that individual. And tell to individual that your 10% of tax is being collected. At the end of the year, you ask him to file the returns. If he is not liable to pay tax to the government, if his income doesn't exceed a particular exemption limit, we will refund 5,000 rupees to him. When you are making a payment, when you deduct certain taxes, when you make payment to him, this type of deduction is called as tax deduction at source. This kind of payment deduction is called as what? Tax deduction at source. I repeat it once again that when you are making a particular payment, when you are making the payment by deducting certain amount of payment, but a certain amount of tax, this is called as tax deduction at source. It applies to salary. When you are making paying salaries to the employees, you need to deduct the TDS. When you are making the interest payment, when you are paying the interest or commission, you need to deduct the TDS. Okay, whatever the TDS you deduct, you need to deposit it to government treasury. Whatever the TDS you have collected, you need to pay it to the government. How you will pay it to the government? There is a challan. There is a challan by name challan ITNS 281. You need to pay through this particular challan. Remember this challan. You can expect question out of this. Next, look at TDS due dates. Forms we have. See, in the income tax department, 24Q, you need to record TDS on salaries. 27Q, you need to record TDS on all payments other than salaries, like commission, interest, and all. 26QB, TDS on sale of property. For example, okay, you are buying a property, and property is of huge amount of money. Yes, of course, properties will be a huge amount of money transactions. When you are buying a property, government says it, you bought a property, no. You made a huge payment to the seller. Don't know seller will pay tax to government. You do one thing. You are the buyer, no. You are the buyer, no. You are buying the property and you are making the payment. When you are making the payment, deduct some tax in this, give it to the government. If you are making those type of transactions, 26QB falls under 26QB, TDS on sale of property. Next, if you are paying the rent, if you are deducting the TDS on rent, you need to deduct it at 26QC. I just want you to remember this TDS returns files because you may have a question on this. You can at left hand side, these forms may be given, and right hand side this may be given, and you may be asked to match the following. Next, okay, form 16 will give the information of TDS on salary payment, and this form is generated yearly. Form 16A, TDS on non-salary payment, quarterly generated. TDS on sale of property, it is every transaction. Next, TDS on rent, every transaction, form 16C. I just want you to remember the form and what exactly certificates. I just want you to understand what certificates are this. 16 is salary payment, 16A is non-salary payment, 16B is TDS on sale of property, 16C is TDS on rent. You need to expect at least one question from TDS, mind you. Next. Yes, important thing. Before I move forward to the question, I want you to understand this. Look here, taxation is very much dynamic. Let me take a plain slide and let me speak about this. That see, taxation, tax laws are very much dynamic. It keeps on changing. I may not be wrong if I tell you that finance doesn't change as much as tax changes. Accounting doesn't change as much as tax changes. marketing, HR, environment aspects doesn't change as much as tax changes. Very much important that you should always have the knowledge of recent changes. You should always have the knowledge of recent changes, because from recent changes, you need to expect some questions. You need to expect the income tax, indirect taxes, whatever you will have. Fine. What exactly I'll do is, yes, over to you, organizers committee. Sarwan sir.
Yes, Shruti ma'am.
Yes, sir.
Yeah.
Thank you so much, Nawaz sir, for giving us such an informative and knowledgeable session you have shared with all the participants and all of us. Really, it was very nice and well eye-opening for us, and it was too informative. Thank you so much in this short time. Actually, short time because you really gave us a lot of information. Now, I request our Professor Ashwini HM to deliver the vote of thanks.
A very good evening.
Not audible.
On behalf of I, Ashwini Hachin, Jain College, and the entire fraternity of the Institute, I thank the Almighty for making today's session a grand success. I thank our chairman, Dr. Chandraj Roychand, in absentia, for his undying support to Jain College. I extend my heartfelt thanks to our principal, Dr. Naveen Kumar CM, who has always been a backbone and who always guides us to reach new heights and beyond. Thank you very, very much, sir. I extend my generous thanks to Professor Mohammed Nawaz, who shared his insights on the topic income tax. Sir, the 2 hours that we spent with you today was very insightful and very informative. I'm sure all the participants have done the due notes and they will make sure that they study them as well. Thank you very much for sparing 2 hours of your busy schedule and being a part of our session. Thank you very, very much. A special thanks to the organizing committee and for organizing this entire workshop, without which the participants wouldn't be able to get connected to the experts. Thank you, IQAC team, Jain College, Vasri campus. I would like to extend my thanks to all the participants without whom the session would have been incomplete. Thank you for sparing your time and being a part of the workshop. Lastly, I would like to thank all the teaching, non-teaching, and the technical team without whose help the session would have been incomplete. Thank you all. Thank you once again. Have a great evening. Over to Dr. Saravanan.
Yes, Sarwan sir.
Yes, sir.
Just 2 minutes, sir.